Let me tell you exactly what I would do if I woke up tomorrow and the stock market had crashed 50%. Not what I might do, not what I would consider doing, what I would actually do. Because I have lived through this scenario multiple times. I have seen markets cut in half. I have watched trillions of dollars evaporate in a matter of weeks. And every single time, I have done the same thing. I have bought aggressively while everyone else was selling in panic. The crash of 2008, the crash of 2000, the crash of 1987, the crash of 1973 and 1974. I was there for all of them. And I can tell you with absolute certainty that those moments of maximum fear, those moments when it feels like the financial world is ending, those are the moments that create generational wealth. But here is what most people do not understand. You cannot wait until the crash happens to figure out what you want to buy. By then, it is too late. Your emotions take over. Fear clouds your judgment. You freeze when you should be acting. That is why today, right now, while markets are calm and your thinking is clear, I am going to share with you the only 4 stocks I would buy if markets crashed 50% tomorrow. These are not speculative bets. These are not hot tips. These are businesses I have studied for decades. Businesses with competitive advantages so durable that a 50% price decline would not be a warning sign. It would be a gift from the investing gods. And I'm going to explain exactly why each one makes the cut, so that when the next crash inevitably comes, you will know exactly what to do. Let's get into it. Before I reveal these 4 stocks, let me take you back to a moment that shaped everything I know about buying during crashes. October 2008. Lehman Brothers had just collapsed. The financial system was on the brink of complete meltdown. Banks were failing. Credit markets were frozen. The Dow Jones had dropped from over 14,000 to under 8,000 in just over a year, and it was still falling. Every expert, every talking head, every financial professional was predicting total disaster. They said we were heading into another Great Depression. They said the banking system would collapse. They said capitalism itself was in danger. And you know what I did? I wrote an op-ed for the New York Times. The headline was simple: Buy American. I am. People thought I had lost my mind, but I saw something they could not see. I saw that American businesses would still be operating in 10 years and 20 years and 50 years. I saw that people would still drink Coca-Cola, use credit cards, and need insurance. I saw that the fear was temporary, but the value was permanent. If you had bought stocks in October of 2008 and simply held them, you would have made 5, 6, 7 times your money over the following 15 years. The people who panicked and sold locked in their losses forever. The people who had the courage to buy created wealth that changed their families for generations. Here is my honest concern about most investors. When the crash comes, they will know all of this intellectually and still not be able to act on it. Because knowing what to do and having the conviction to do it under extreme emotional pressure are 2 entirely different things. My takeaway from 1987, from 2000, from 2008, and from every crash before and since. Buying during a crash is not brave. It is not contrarian for the sake of being contrarian. It is the inevitable result of having done the work beforehand. When you know with deep conviction which businesses you want to own and at what prices, a crash is not scary. It is like walking into your favorite store and finding everything marked down 50%. You do not panic when prices drop, you load up the cart. Now, let me walk you through my 5 filters for crash investing. Because not every stock that drops 50% is a good buy. In fact, most of them are not. Some stocks drop 50% because the business is fundamentally broken. Some stocks drop 50% because they were wildly overvalued to begin with. Some stocks drop 50% and then drop another 50% because the problems are even worse than anyone realized. The stocks I want to buy have very specific characteristics. First, the business must be nearly certain to exist and be profitable 10 years from now. Weak companies go bankrupt in crashes. I only want businesses where survival is guaranteed, where the product or service is so essential that people keep buying no matter what happens to the economy. Second, the business must have a genuine competitive moat. A brand so powerful customers pay premium prices out of habit and emotion. A network effect, where the product becomes more valuable as more people use it. Cost advantages competitors cannot match. Regulatory barriers that keep new entrants out. Without a moat, even a good business can be destroyed by competition over time. Third, the business must generate strong free cash flow. In a crash, capital becomes scarce and expensive. Companies that generate their own cash are in control of their destiny. Companies that depend on constant fundraising are at the mercy of market conditions. Fourth, the business must have capable and honest management. Over 10 or 20 years, management decisions compound just like investment returns. Good managers allocate capital wisely and navigate challenges effectively. Bad managers destroy value through poor decisions and empire building. I want partners I can trust. Fifth, and this one is critical for crash buying specifically, the stock must offer a significant margin of safety at the crash price. Even great businesses can get cut in half. But if you buy a great business at a price well below its intrinsic value, time is on your side. You can afford to be patient. You can afford to be wrong about the timing. The margin of safety protects you from permanent loss, even when things get worse before they get better. These are my 5 filters. And when I apply them rigorously, very few stocks make the cut. But the businesses that pass all 5, those are the ones I want to own in a crash. Those are the ones where a 50% decline is not a warning, it is an invitation. Drop a comment right now. Have you ever bought stocks during a market crash? Because what I am about to share applies directly to the decision you will face when the next one arrives. And it will arrive. Stock number 1. Apple. Ticker AAPL. Most people look at Apple and think it has already had its run. One of the largest companies in the world. How much upside can there possibly be left? That reaction is exactly why Apple remains one of the most misunderstood businesses in the market. Apple is not a technology company. Apple is one of the finest businesses ever created in the history of capitalism. And I do not say that lightly. I have studied thousands of companies over 4 decades. I have seen great businesses and I have seen pretenders. Apple is the real thing. Over 1 billion people carry an iPhone everywhere they go. They wake up with it, they go to sleep with it, and they chose to pay a premium price for this device even though cheaper alternatives exist. That tells you something profound about the value Apple creates. People are not buying iPhones because they have to. They are buying them because they want to. Because the ecosystem is so integrated that switching would be painful. Because the brand represents something they want to be associated with. But the iPhone is just the beginning. What really matters for the long-term thesis is services. Every month, Apple collects recurring revenue from over 1 billion people. iCloud storage, Apple Music, App Store purchases, Apple TV Plus, Apple Pay, Apple Arcade. 10 years ago, services was a small part of the business. Today, it generates over $80 billion per year in revenue. High margin, predictable, sticky, and still in the early stages of compounding. Here is my honest concern. In a 50% crash, Apple would likely decline because of macroeconomic panic, not because the business is impaired. iPhone users would not switch to Android because the market crashed. Services subscribers would not cancel iCloud storage. The ecosystem would remain completely intact. You would simply be getting a piece of this extraordinary business at half price. My takeaway: Apple generates over $100 billion in free cash flow annually. At a 50% lower stock price, you would be buying that cash flow at a dramatically lower multiple. If Apple crashed 50% tomorrow, I would back up the truck. Not because I'm speculating on a quick recovery, because I would be acquiring one of the greatest businesses ever built at a price that offers exceptional long-term returns. Stock number 2, Visa, ticker V. Most people think Visa is a credit card company that lends money to consumers and makes money on interest payments. That is completely wrong. Visa does not lend money. Visa does not take credit risk. Visa is something far more valuable than that. Visa is a toll road. Every time someone swipes a Visa card anywhere in the world, Visa takes a small percentage of the transaction. Not the credit risk, just a fee for processing the payment. The banks take the credit risk, the merchants pay the fees. Visa just sits in the middle collecting tolls on trillions of dollars of transactions flowing across its network every year. The operating margins are extraordinary. Over 60% of revenue drops to operating income. That is a level of profitability that almost no other business can match. And the growth runway is enormous. In developed markets, 60 to 70% of transactions are electronic. But in emerging markets, Africa, Southeast Asia, Latin America, the vast majority of transactions are still done in cash. As these economies develop, as more people join the banking system, Visa's transaction volume will continue to grow for decades. Visa also benefits from inflation automatically. When prices go up, the value of transactions goes up. Visa's percentage fee is based on the transaction amount. Inflation grows Visa's revenue without the company doing anything at all. Here is my honest concern. New payment technologies, digital wallets, buy now, pay later, cryptocurrency, are often cited as threats to Visa. What most people miss is that these technologies usually run on top of Visa's network. When you pay with Apple Pay, the underlying transaction still goes through Visa. When you use PayPal, it is often connected to a Visa card. The new technologies are not replacing the network, they are adding transaction volume to it. My takeaway: there are only two major global payment networks, Visa and MasterCard. Building a competing network would require convincing millions of merchants, billions of consumers, and thousands of banks simultaneously. The chicken and egg problem is essentially impossible to solve. If Visa crashed 50% in a market panic, you would be buying one of the highest quality businesses in the world at a significant discount. 60% operating margins, double-digit revenue growth, decades of runway, a moat no competitor can realistically challenge. That is the kind of opportunity I dream about. Stock number 3, Costco, ticker COST. This one surprises most people. Costco is a retailer. Retail is supposed to be a terrible business, low margins, intense competition, vulnerable to e-commerce disruption. Why would I want to own a retailer? Because Costco is not a retailer. Costco is a membership business disguised as a warehouse store. And understanding that distinction is everything. Most retailers make money by marking up products. Buy something for $10, sell it for $15, pocket the difference. Costco barely marks up its products at all. The average markup is only about 11%, compared to 25 to 30% at typical retailers. Costco is not trying to make money on the merchandise. Costco is offering such incredible value that customers feel compelled to pay the annual membership fee. And that membership fee is where almost all of the profit comes from. Over 60 million households paying membership fees, a renewal rate of over 90%. 90% of members renew every single year. That is subscription-like recurring revenue with almost no marginal cost. And here is the moat that makes this nearly impossible to replicate. Because Costco operates on razor-thin merchandise margins, they can offer the lowest prices. Because they offer the lowest prices, customers join and renew. Because customers pay membership fees, Costco can operate on razor-thin margins. It is a self-reinforcing loop that has been compounding for decades. Here is my honest concern. A recent quarter showed membership growth coming in slightly below expectations. In a business this dependent on renewal rates, any softness in that metric gets the market's attention immediately. The valuation Costco commands leaves no room for disappointment. My takeaway: Costco's membership renewal rates do not decline because the stock market crashes. People still need to buy groceries and household goods. The business would keep humming along, collecting membership fees and serving its loyal customer base. If Costco crashed 50%, the business would not be broken. The price would just finally reflect something closer to reality. And that is exactly when I want to own it. Stock number 4, Berkshire Hathaway, ticker BRK. Yes, my own company. And before you think this is self-serving, let me explain exactly why. Berkshire Hathaway is not really a stock. It is a collection of over 70 operating businesses, plus a massive portfolio of publicly traded stocks, plus over $300 billion in cash and short-term investments. When you buy Berkshire, you are buying insurance companies like Geico. You are buying a railroad that moves goods across America. You are buying an energy company with utilities and pipelines. You are buying See's Candies and Dairy Queen and Duracell and Benjamin Moore. You are buying stakes in Apple and Coca-Cola and American Express. This diversification matters enormously in a crash scenario. Some businesses do better in recessions, some do worse. Across 70 businesses in many industries, Berkshire's overall earnings are more stable than any single company. But the real advantage Berkshire has in a crash is the cash. Over $300 billion sitting on the balance sheet waiting to be deployed. When other companies are struggling to survive, when credit markets are frozen, when everyone is desperate for capital, Berkshire can be the buyer of last resort. We did this in 2008 with Goldman Sachs and General Electric on terms that generated billions in profits. Most companies have to sell assets in a crash to raise cash. Berkshire can buy assets in a crash because it has cash. That asymmetry means Berkshire often emerges from crashes stronger than it entered them. Here is my honest concern. At $300 billion in cash, some argue Berkshire is carrying more liquidity than it can deploy efficiently. The sheer size of the company limits the universe of meaningful acquisitions. What worked at smaller scale requires increasingly large opportunities to move the needle. My takeaway: if Berkshire crashed 50%, you would be buying a company with over $300 billion in cash at a lower price than the cash alone. You would be getting the 70 operating businesses essentially for free. You would be getting the entire stock portfolio for free. That kind of mathematical absurdity occasionally happens in crashes, when prices disconnect completely from intrinsic value. When it does, you buy. Let me bring this all together. 4 businesses, one common thread running through all of them: durability. Apple tells you that an ecosystem with over 1 billion locked-in users does not get disrupted by a stock market crash. Visa tells you that a toll road collecting fees on every electronic transaction in the world gets more valuable as the world goes cashless. Costco tells you that a membership model with 90% renewal rates keeps compounding quietly, regardless of what the Dow Jones does on any given day. And Berkshire tells you that holding $300 billion in cash, while everyone else is desperate for capital, is one of the most powerful positions in investing. Here is the investing truth I want to leave you with. Crashes will come. They always do. The history of markets is a history of periodic panics, where prices decline sharply and investors lose their minds. The specific trigger never matters. What matters is how you respond. Will you panic and sell at the bottom, locking in your losses permanently? Will you freeze and do nothing, watching the opportunity pass? Or will you have the preparation and the conviction to buy wonderful businesses at bargain prices? The choice is yours. But from 4 decades of doing exactly this, I can tell you that the investors who build real wealth are not the ones who predicted the crash. They are the ones who were prepared for it before it arrived. They had the watch list. They had the levels. They had the conviction that came from understanding the businesses they owned. And when the moment of maximum fear arrived, they did the one thing that separates wealth builders from everyone else. They bought. Hit subscribe and turn on notifications so you never miss a breakdown like this one. And drop a comment telling me which of these 4 you would buy first. I read every single one. No sponsors, no fluff, just the analysis. See you in the next one.